everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you today's schedule of events for Tuesday, January 19th. Now, overnight, we had a slew of economic indicators out of China. Almost all of them came in below consensus and below the previous period's figure. Fourth quarter GDP, the big one, was 6.8% year-on-year, down from 6.9% year-on-year in Q3. This doesn't seem like a major slowdown to me, but since the official forecast for this whole year is 6.8%, that means either things can't get any worse or that they'll have to lower the forecast further, which would be a blow to confidence. Chinese industrial production came in line with expectations, but retail sales and fixed asset investment were also below estimates and below November's data. Poor. Look for more weakness in the Australian dollar and the other commodity currencies. Now today at 1000 GMT, we get the German ZEW economic indices. The current situation and the expectation indices are both expected to decline. Sentiment surveys recently have generally shown more buoyant conditions than the hard data, such as industrial production, but this may be the first indication that sentiment's starting to catch up with reality. Changing sentiment towards German growth could weigh on the euro. Then at 1200 GMT, Bank of England Governor Mark Carney will give a lecture at the London School of Economics. His talk will come just a short time after the December inflation figures for the UK come out. They're expected to show inflation still running well below the Bank of England's target. Falling oil prices and slowing wage growth suggest that it's not likely to hit the target anytime soon either. So Governor Carney is expected to use this opportunity to renounce his previous assessment that the Monetary Policy Committee would begin to consider raising rates around the turn of the year being 2015 to 2016. That wouldn't necessarily be news, really. The market came to the same conclusion some time ago. In fact, since August, the market's expected that rates won't rise until the second half of this year at the earliest, and recently that's been pushed out to 2017. Nonetheless, formally abandoning that target could depress the pound. Then, overnight, New Zealand will release its fourth quarter CPI. As you can see from the graph, the Reserve Bank of New Zealand tends to adjust interest rates in line with changes in inflation expectations, not just changes in actual inflation. The market looks for inflation in the fourth quarter to be lower than in the third quarter. If it does come in as expected, that could further depress expectations about future New Zealand inflation, especially against the background of slowing Chinese growth. That might heighten expectations of an RBNZ rate cut and depress the New Zealand dollar. Currently, the market's only pricing in a 26% chance of another rate cut this year, so there's still plenty of room for expectations to change and for the New Zealand dollar to weaken accordingly. This is Marshall Gittler, Head of Investment Research here at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.